went down. If market rate went up, your bond is no longer worth what you paid for it. Market rates drop below the coupon rate, your bond is worth more. If it stayed the same, your bond's worth the same. Now, you need to realize that the years left until it matures has a bearing on the value of the bond. Because say your coupon rate is greater than the current market rate, right? It's great. But it's not so great if that discrepancy is in year 9 of 10. It's better if it's year 2 of 10, you understand? So you have a higher coupon rate than a market rate. Your bond is more valuable if that rate difference is early in the life of the bond. You're going to collect more interest along the way. If it's towards the end of the bond, there's not much of a difference. So what it's trying to tell you is once you reach year 10, just because you have a higher coupon rate than the current market rate doesn't mean anything anymore, because it converges, meaning the value of the bond ends up being $1,000 at year 10. There's no more interest rate. Exactly, you already collected everything. Right. The benefit was already reaped. What happens is at year 10, the bond has no more interest payments, so it's worth the face value. So that's what it means by the bond value converges to par at maturity. Meaning at maturity, the value of any bond must equal its par value because the rate difference doesn't matter anymore. You reached the last year.
You reached the life of it.
Exactly. So there's no difference. Okay? Yield to maturity. Yield to maturity, also in YTN, is the rate of return earned on a bond held to maturity. It's called the promised yield. It assumes no default. We'll talk more about that, but just keep that in mind. It's the rate of return earned on a bond that's held to maturity. We'll talk about current yields. That's nothing more than the coupon payment divided by the current bond price. Capital gains yield, that's the change in bond price divided by the beginning price, and total return, which is a combination of the two. Okay. So you brought up, there has to be certain premiums, right? So you have inflation premium, that's compensation for expected inflation. We'll talk about maturity risk premium. This is compensation for interest rate risk, meaning if you have a bond, right? What is more subject to interest rate risk? Is it a 1-year bond or a 30-year bond? Which one gives you more risk in terms of the fluctuation of interest rates? 30, right? So that's something you would think about. So when it comes to maturity risk premium, it's compensation for interest rate risk, which is higher for longer term bonds. Default risk premium, that's compensation for risk that the issuer will default. So when we talk about the mom and pop versus Johnson & Johnson, we know that the mom and pop has to offer a default risk premium because they're more likely to default because their credit rating is not nearly as high as a company like Johnson & Johnson. So they have to offer a premium rate versus Johnson & Johnson. So that's what you were referring to.
They're going to give you an excuse to go through.
Exactly, that has to be worth the risk. Exactly, yeah. Okay, so all these we'll talk about with bond spreads. Okay, and then liquidity premium is the compensation for risk that the bond will be difficult to sell at a fair price. So if you're dealing with, say, a treasury security, those are a lot more marketable than, say, a small mom and pop bond, right? So there's liquidity premium also associated with mom and pop in the sense that you can't convert it to cash as easily as something that's more frequently traded, like a treasury security. Okay, we'll talk about bond ratings and risk. So bond ratings, there are certain agencies that rate bonds and it assesses the default risk that these bonds have with different companies. They're rated, AAA, BBB, whatever the case may be. Higher ratings indicate a lower risk. And how do they determine that risk? They do an analysis of different financial ratios. I believe they're in chapter 2, I believe. Debt ratios, coverage ratios, profitability ratios. All those are used to determine the bond rating. We can also talk about other factors. We'll talk about bond and contract provisions, earning stability, regulatory environment, and accounting policies. We'll also talk briefly about call provisions, sinking funds, and then bankruptcy, right? So you have different types of bankruptcy. There's reorganization bankruptcy and then liquidation. Reorganization bankruptcy is when a company has to restructure its debt and is given a chance, a lifeline in a sense, to operate without having to liquidate, okay? Chapter 7 is the worst of all, is liquidation, and involves completely stripping the company of its assets and selling those assets to repay the creditors according to a priority list. Usually the ones that get screwed are the unsecured creditors. And anyone know what unsecured means?
That's, you lose money, lose money when it's unsecured.
So unsecured means there was no collateral attached to
Okay.
your debt. Okay, obviously if you when you take out a mortgage on a property and you sell the property, it's secured, so you have to pay, whatever you sell the property for, you have to pay back the mortgage on it.
Right.
When it's unsecured, they basically lend you money in good faith.
Not in collateral.
Exactly, no collateral. So they are usually the ones that get screwed if a company liquidates because they're at the bottom of the totem pole, right? They're at the bottom priority list. Usually they end up not getting anything upon liquidation. Someone might say, but what if there is enough? Think about it. Why would a company need to liquidate if there is enough? So you're obviously in financial ruin at that point, and there's very little to salvage, and if you're unsecured, you're more likely not to collect anything. And then interest rate risk, reinvestment rate risk, and term structure. So I want you to realize what interest rate risk is. It's the risk that rising interest rates, like we talked about, will cause bond prices to fall, right? We've established that. If rates go up, any pre-existing bonds
Go down.
value goes down, right? And vice versa, right? Long-term bonds are more sensitive to interest rate risk because, like we said, a 30-year bond is more likely to suffer from a interest rate fluctuation than a 1-year bond, right? And then reinvestment rate risk. Think of this as the other side of the coin on that. So it's the risk that cash flows will need to be reinvested at a lower rate in the future. Okay, so think of it like short-term bonds are more exposed to this risk because say you buy a 1-year bond and it's paying 5%. That 5% is only good for 1 year.
Yeah.
So when you collect the full value of the bond, think about it. If you want to continue, you have to reinvest it, and hopefully the rates are the same. If you're in a 30-year bond, you're locked in for such a long period that you're not worried about reinvesting and earning the same rate.
Yeah.
So there's more reinvestment rate risk with a short-term bond than a longer-term bond. Okay, because think of it, in your mind, you have to say, okay, what am I going to reinvest a short-term asset into? With the long-term, you're fixed for many, many years, so that's not an issue. And then we'll talk about term structure of interest rates. I'll Google one of them to see if it's basically the relation between interest rates and maturities, and is known as a yield curve. Okay, so I want you to take away understanding the various features. We talked about, par value of a bond. Again, that's the face amount of the bond that the coupon interest rate is based off of, right? It's a stated rate that you multiply by the par value to calculate your annual interest payments, okay? We also talked about maturities, the number of years until the bond's principal or par value needs to be repaid, right? The further out you go, obviously the less number of years to maturity. You have the issue date, which is the date that the bond was initially issued, and default risk, the risk that the bond issuer will fail to make interest or principal payments. All right? So hopefully this just put like a little idea of what to look for in the slides that we're going to go over now. Okay, topics in this chapter. All right, we already kind of talked about key features of bonds. We'll talk about bond valuation, measuring the yield, and assessing risk. But I want you to focus on the red. So we need to understand that issuing bonds are a way that governments and corporations use to borrow money from creditors, right? You can buy treasury bonds, which is from the government. You can buy corporate bonds, right, that are from corporations. You can also buy muni bonds, which are from municipalities, such as state and local governments, okay? There are 4 types of bonds: treasury, corporate, municipal, and foreign, okay? At the end, I want you to get an idea of why understanding bonds is very important. So at the end of 2021, there were an outstanding of $25 trillion worth of U.S. Treasury securities, right? $4 trillion of municipal securities, and $7 trillion of corporate bonds. So you need to understand that this is an enormous amount of debt in the forms of bonds. So it's extremely important to understand debt and interest rates, okay? Remember, we always come back to this at the start of every lecture, right? We always went over this. So remember in the early chapters, we calculated net operating profit after taxes. Remember, we looked at the income statement of a company. We looked at, you know, earnings before interest and taxes, and then earnings after taxes, right? From that, we subtract required investments in operating capital to arrive at free cash flow. If you remember, free cash flow is the amount of money available to distribute to investors, whether it's, you know, stockholders or creditors, right? So this is the amount of money that a company has to distribute, okay? We talked about time value of money in terms of valuing a company. We want to arrive at the present value of each of the company's free cash flows going out into years, right? So the present value, or the value of the company, is the present value of those free cash flows that we calculated. And then we talked about, we discounted by a certain interest rate, right? That interest rate, in this case, is the weighted average cost of capital. Weighted average cost of capital is a blend. It's a blend of the cost of debt and the cost of equity. How is a company financed? It's financed by issuing debt, right, in the form of bonds, and it's financed by issuing stock to stockholders, right? Neither the creditors nor the stockholders are giving the company money for nothing in return, right? Last chapter we talked about the rate of return expected from a stockholder, right? This week we're talking about the rate of return expected from a debt holder, okay? So the weighted average cost of capital is a blend of the cost of debt and the cost of equity, and that weighted average cost of capital is going to be used to discount the free cash flow to a present value. That present value is known as the value of the company, okay? So just on the left, you see a note: a bondholder's return is a cost from the company's point of view. This cost of debt affects the firm's weighted average cost of capital, known as WACC, which affects the company's value, okay? So just understand that. We covered the cost of equity last week. We're covering the cost of debt this week. All right, so key features of a bond. As we mentioned, par value. This is the face amount that is paid at maturity, and we're gonna assume $1,000 throughout the lecture, okay? It can be different amounts, like Jimmy, yours was a different amount, but we're assuming $1,000 in this case. The coupon interest rate, again, this is the stated interest rate per the agreement. You multiply that rate by the par value to get the amount of interest that you are guaranteed every year, okay? So if you buy a par value bond for $1,000 and the stated interest rate is 10% paid annually, you are guaranteed to collect $100 every year, okay? And this amount is generally fixed. The coupon payment, okay, as I mentioned, remains in force throughout the livelihood or the life of the bond, okay? So again, that 10% on the $1,000 bond is guaranteed throughout the life of the bond. Again, it's a contractual agreement with the issuer, okay? And then you have floating rate debt. We're not gonna cover it, but I want you to know floating rate debt is where the interest rate does fluctuate, and it's usually common with investors who are worried about market interest rates going up, right? But we'll focus on fixed for now. Maturity, as we mentioned, these are the years until the bond matures and the par value must be repaid, okay? The issue date is nothing more than the date when the bond was issued, and the default risk is the risk that the issuer will not make its obligated interest or principal payments, okay? And just another note, although rare, some bonds could be perpetual bonds. Usually those are found in foreign countries because they have no maturity date. So they kind of work like an annuity. It's a guaranteed, you know, but we're not really talking about that. Just know those do exist. All right. Okay. Let me ask you something. If you're the CFO of Johnson & Johnson, okay, you're the CFO of Johnson & Johnson, and you gave out bonds paying 10% per year. Okay. Say the market rates are no longer 10% for interest. Say they're 5%. Are you upset or happy?
Pretty upset.
Pretty upset, right?
Yeah.
So one way to
Buy now.
to protect yourself is to incorporate a call provision on the bond. What that means is, I can call back your bond before the agreed upon maturity date. So if it's a 10-year bond and I have a call provision, I can call after 2 years, because I don't wanna have to pay more than I have to.
That's sleazy.
It's sleazy, but it exists. It exists, and investors, it exists, but you gotta realize, this is before you realize what happens with rates, right? This is at the moment in time where your agreed upon rate is the market rate. So if you're an investor, yeah,
I was gonna ask, can the person purchasing the bonds, can they have a provision like that for the company if the rates increase?
It's gonna be the opposite way.
Or does it only benefit the person
it
issuing the
usually
bond?
only benefits
I
the
figured.
issuer, because they're the ones that are creating the security, right?
Okay.
They're the ones that have they're offering the public to purchase that security, but they have their own terms. However, the average investor is not an idiot. If it's a callable bond, they're not gonna just want the market rate.
Right.
They're gonna want a slightly higher rate for the risk that should rates go up, they can call back your bond, okay? Yeah,
So, bond basically, I'm trying to get my head right, so if a company give out a bond, issue a bond.
Yeah.
They're trying to generate cash flow, right?
I'm sorry?
Are they trying to generate cash flow?
Of course, yeah, they're basically
They're
taking out
trying
loans.
to get the cash.
Yeah, they're taking out loans, but think of it like micro loans with a bunch of debt holders, instead of
Okay.
taking a big loan from a bank, they're just taking out a bunch of small loans from debt holders.
Right.
You and I, we go and buy $1,000 from Johnson & Johnson, they just got a bit of cash and now they owe us.
Okay.
Instead of going to a bank and having to pull
Right,
out a
and they
big
have
loan.
to pay the bank for
Right.
more interest rate.
Exactly. So the issuer can refund if rates decline, so that's what a call provision is. So what I said, they can refund you your $1,000 if they realize that the rates actually dropped. That way they don't have to worry about paying you an inflated rate for the duration of the entire bond, okay? So of course, that helps the issuer, but hurts the investor, right? So that comes to a point that you mentioned. So therefore, borrowers are willing to pay more and lenders require more, because someone would have to be an idiot to get the same rate with a non-callable bond as a callable bond. If you have a callable bond, you say, I don't want 10%, I want 14%, I want 13%, okay? Okay, so just understand that borrowers are willing to pay more, so the company that's issuing the bond is willing to pay more in the form of a higher interest rate, and lenders require more, meaning a higher interest rate on callable bonds. Okay, so a call provision is very valuable to a firm, but potentially, because we don't know at that point in time, detrimental to investors, okay? And we explained why, so keep that in mind. Okay, so most bonds have what's called a deferred call and a declining call premium. So I want you to look at the red. So as we said, a call provision generally states that a company must pay the bondholders an amount greater than par if they're called, okay? So not only do they usually pay a higher interest rate, they can also agree that they'll give you more than par value should they redeem. So instead of giving you $1,000, it'll be sort of like yours, Jimmy. Instead of being $18, they give you $25, okay? So they'll give you a form of an interest in the form of a higher par value, okay? So this is called a call premium, because it is a premium to the bondholder, because you're not just getting back the par, you're getting more than par value, okay? But I do want to note that, and there's a formula involved, you don't need to worry about the formula. You need to realize that bonds are often not recallable until several years after being issued, okay? So it's not like they can buy the bond 6 months later back from you. Usually it's not exercisable until a couple of years down the road, okay? So it's known as a deferred call, okay? You gotta realize that bonds go out many years. They go out 10, 20, 30 years, right? So it's a deferred call, might be after 5 years, or whatever the case may be. And basically the bonds are said to have call protection, which is beneficial to the company. So just know that a lot of bonds, if they're callable, they're usually deferred calls, meaning they can't call the bonds until several years after being issued. It's not like they just call it back after 6 months, usually has to wait a certain amount of years. Is that part clear? So most bonds have a deferred call and a declining call premium, okay? Again, the declining call premium means that the further out you are going into the life of the bond, the less that the company will have to pay you, because you've already
You know,
You already got the benefit of the interest rate, so the further out you go, the smaller the premium you will get from redeeming the bond early.
almost like a backwards insurance policy, whole life policy.
Yeah, exactly, that's exactly what it is. So it's an insurance policy for the issuer, and it's, you know, it can be detrimental to an investor. Sinking fund. So I want you to think of a sinking fund. So bonds are issuing all these bonds. I mean, the companies are issuing all these bonds, right? And sometimes you get a little worried. You're like, okay, this corporation has, you know, hundreds of millions of dollars in bonds, and they're all due to expire in the next couple of years, right? You're worried if the company will have the funds available to redeem all the bonds back. So what happens is a company can have something called a sinking fund, and what that is instead of waiting till the end of the life of a bond to redeem at the par value, they can redeem the par value along the way. Okay, so your $1,000, you'll get back maybe $20 every year, $40 every year. You're earning back, not just in one shot at the end, but along the way, you're earning some of your par. It reduces the risk to you as an investor because you're earning back some of the principal early, not at the end of the 10 years. Okay, so sinking fund is a provision to pay off a loan. Remember, bonds are nothing more than loans, right? You're loaning money to a company in return for an interest rate and a return of that loan being made years down the road. So a sinking fund is a provision to pay off the loan over its life rather than all at maturity. Okay, so if you bought a Johnson & Johnson bond at $1,000 and it's a 10-year bond, instead of just getting the interest for the first 9 years and getting the $1,000 at the end, they're gonna say, okay, you don't have to wait and get the $1,000 at the end, we'll minimize that risk. We'll give you, say, $50 every year.
So is that similar to dividends?
No, not dividends. Think about it. Dividends are profit. This is a return to your principal. This is your loan coming back to you. You're reducing the risk because you're not gonna wait hoping that they're gonna give you the full amount of that loan at the end of year 10. You're getting some of your loan back along the way. So it's provision, it's sort of like an amortization of a mortgage, right? Think about a mortgage. A bank loans you money,
Right.
but they only expect interest payments throughout the life of the loan. You're paying back interest and principal. So
Right.
you're reducing the risks to the bank, right? Because you're paying some of the original loan back. It's the same concept here. It's a sinking fund. The corporation is giving back some of that money along the way so you don't have to wait until the end to collect the full amount of the loan. Okay? So it's very similar to amortization, mortgage amortization on a term loan. Okay, again, as I mentioned, this reduces the risk to the investor because it shortens the average maturity. Okay, if you're earning some of the principal back, it's gonna shorten the average maturity. But it's not good for investors. Why wouldn't it be good investors? In what case? That's if rates decline, right? So think about it, if they're paying you back some of the principal along the way and rates end up dropping, that's not good for you because you should be earning more interest, but because they're getting you back some of the principal, you're earning less interest as a result. Okay, so that's also a thing to consider. It's not good for the investor if rates decline after the issuance. Okay, so here I have a note. Hopefully makes it a little clearer. Although sinking funds are designed to protect bondholders by ensuring that an issue is retired in an orderly fashion, so it's meant to protect bondholders to make sure that the company is paying back the bond's par value in an orderly fashion. But you should recognize that sinking funds can also work to the detriment of a bondholder. For example, suppose that the bond carries a 10% interest rate, but that yield on similar bonds have fallen to 7.5% interest rate. So your interest rate is better than the current market rate.
Right.
So a sinking fund call would require, think of it like an investor having to give up a bond paying $100 in exchange for a bond paying $75 because they're getting back some of the principal of which that interest rate is no longer good for because you got back some of that principal and you're gonna reinvest it in something that pays a lower interest rate. So that's where it can be tricky for the investor. So that harms the bondholders when those bonds are being called, right? But keep in mind that sinking funds are designed to be safer for the bondholders. So just, that's all I want to say on sinking funds. So
Saying that you're only paying taxes on the interest. not
absolutely.
the- Okay.
Yep, absolutely. Just like any loan, the principal is a return of your own money. interest is the income that you're making from that loan.
So,
Actually,
quick
and as I mentioned in, I think the first class, there's one type of bond where the interest is non-taxable. I'll give 5 points on the quiz if anyone knows what bond it is. What bond, what interest on what type of bond is non-taxable? And remember, if you guys remember, I gave an example of a corporation bond
Mhm.
and another type of bond where the rate was higher at first, but I always said, consider the tax implications. And after tax, the other one had a higher return.
It's on the summary on the first chapter.
Alright, my offer expires in,
What?
at 6:53.
Oh, come on.
If someone can pull it up.
6:53, 6:55.
Alright, 6:55.
Alright.
You said not taxable?
Yes, non-taxable. It's the only bond type where the interest is non-taxable.
You said bonds only come from the government, right?
No, they can come from corporations like Johnson & Johnson, it can come from the government, it can come
Start with him. You know, YouTube. The brain is getting there.
You are correct, it starts with an M.
Yeah. Municipal.
Damn, you got it.
Municipal.
Municipal bonds. Bonds issued by state and local governments, the interest is non-taxable. And it was an example I
I
gave.
know it started with an M.
Yeah, it was an example I gave where corporations giving, say, a 5% interest rate,
Right.
but the municipal bonds paying a 4% interest rate, someone that doesn't consider
You asked
taxes.
me the question, we
Yeah.
got one, which one did I want?
Yeah, and the answer was municipal, because you care about the after-tax impact, and
Right.
after tax, the municipal, although it had a lower stated rate, gave you a better return. Alright, so Jimmy, 5 points next to us. Alright, so sinking funds are generally handled in 2 ways, as we mentioned. So again, sinking funds are a way that corporations are basically buying back the bond ahead of time, okay? And there's 2 ways that they can do that.
Hold up now, stop right, because before you said recall, right?
Callable.
Call. It's not the same?
It's similar. So callable is they can buy it all in one shot
Okay.
after a certain time period. Sinking funds are not designed in that way. They're supposed to be beneficial to the bondholder, because rather than having to wait until 10 years to recoup your full amount of the loan, they're buying back your loan little by little. So it's reducing your risk, because now you're getting back some of the original loan that you received, that you gave out, getting it back. So it's a bit different. Alright, so sinking funds, they're handled in 2 ways. So the corporation can call an X percentage at par per year. Okay, so
Okay.
they'll call back, say, 10% of the bond after a couple of years, okay? So, obviously, the corporation will want to do this. It will incentivize them more if the market rate is below the coupon rate, right? If the market rate is below the coupon rate, that means the bond is currently selling at a premium,
Okay.
right?
Like the issues.
Right, so they would not wanna buy that in the open market, they would just wanna, exercise the call and buy an X percentage from the bondholders. Okay, so they're, obviously they can't buy the 100%, but they'll buy whatever was agreed upon, say 10% of the bond ahead of time. The other option is to buy bonds in the open market. So the company, say the market rate is now above the coupon rate and the bond is selling at a discount, okay? Are you with me? So, remember what I said, if the bond has a rate that is below the current market rate, that bond is worth less than $1,000. So why would the corporation buy back your bond at $1,000 when they can go to the market and buy your bond at the discount rate? Remember, your $1,000 bond is no longer worth $1,000, it's worth $800.
Right.
So why would the bond give you back $1,000 and then you just go, like, no, I'll buy this amount of bonds because I know they're worth less because the rates have gone up, I'll buy it at the discounted rate of $800. So that's 2 ways that that companies can exercise the sinking fund, yeah.
Is there a time value that's associated with that?
Absolutely, yeah, remember, as I mentioned, if you're in year 9,
Yeah.
and you have a coupon rate that's higher than the market rate, it's not much of a difference if it's a 10-year bond. There's only 1 year left to collect the difference in rate. But you're in year one, and market rates have, are they already below your coupon rate? Your value of bond is much higher because you're locked in for the next 9 years with a much higher interest rate. So think of it like, what's worth more to you? A 10-year security that has an interest rate that's higher than the current market rate, or a 1 year security that has an interest rate higher than the market rate? You want the 10-year. You're gonna benefit from a longer period of time. So time, interest rates, all that matter when you're valuing a bond.
Like, I guess like what my question was, like if you're like on a 10-year bond, right?
Yeah.
Would it make a difference on the premium if someone's buying you out of it or calling it at the 3 year mark versus like a 6 or 7 year mark?
Yeah, we're gonna talk about that. That's called the yield to call,
Okay.
and we'll realize that it's not a what do you call it? It's not a subjective calculation. There's a formula involved in what you calculate to be a premium and a discount. And you might have guessed it. We use the present value function to calculate what the value of a bond that has a certain amount of time left with a certain interest rate left at a current market rate, what that's worth today. Okay? So in my case, what I said, if you're only left with 1 year out until maturity, it's not really much of a difference. But if you're 10 years out to maturity with a coupon rate that's higher than the market rate, it makes a big difference on your present value calculation. Remember, present value is what your bond is currently worth, okay? Okay, so we gotta realize that bonds sell on the open market at a premium or a discount relative to the par. Remember what we said, if the coupon rate is the same as the market rate, does it sell at a premium, does it sell at a discount, or does it sell at par? If the coupon rate is the same as the market rate.
There's no change.
Right, what is that called? Par. It's at par. It's at the original base amount.
Now you're playing golf.
Exactly. Now, if the coupon rate is higher than the market rate, is the bond selling at a discount, par, or premium? Very good. And if the coupon rate is less than the market rate, is the bond selling at par, discount, or premium? Discount. Very good. Very good. Okay, so just so far you're with me, understand that rates dictate everything, and time have everything to do with the value of the bond, okay? All right, so now we're gonna talk about how we incorporate our concepts from the time value of money into valuing a bond, okay? So remember, the value of any financial asset, whether it's stocks, whether it's bonds, whether it's leases, whether it's a building, is simply the present value of the expected cash flows, okay? When you value a property, right, a real estate property, and we've done this a lot at my firm, you don't care about anything other than what your property is generating right now per its lease agreements. And what you do is you forecast, they say 10 years out.
Yeah.
And then at the end of the 10 years, obviously you're gonna forecast, think of it like interest payments, but in this case, it's like the profitability of the property. Next 10 years, right? Income that the property is making. At the end of year 10, instead of having the par value, building doesn't have par value. What would be your equivalent of a par value at the end of year 10? It will be the value of the building, right? So that's how you value assets. You value it at the present value of the cash flows you anticipate. So when it comes to something like a property, instead of thinking about interest rates and par values, think of it like the operating income that the building has along the way, say for 10 years. Then in year 10, instead of a par value, you think of it like the value of the property itself, and you just go ahead and you sell it.
Okay.
So it's very, very involved, but it's very similar in concept. All right, so let's talk about the value of a 10-year, 10% coupon bond if the market rate is 10%, okay? So I want you to look at this time value function. So we have, our 10% coupon, right? We're using $1,000 as par. Remember we said that?
Mm-hmm.
We're gonna assume par value of 1,000. So 10% on 1,000, we can do simple math, that's $100 per year. So at the end of year 1, it's $1,000. At the end of year 2, it's $1,000. All the way through year 10, it's the $100 plus the 1,000, okay? So it's $100 every year until the last year, it's the 100 plus the 1,000, because the 1,000 you're getting back the original amount of the bond, $1,000 par.
So 10%, you actually get 1,000 before you get to the 1,000, right?
Yeah, because
Or
it's
they-
10
they
years
give
out,
you-
it's
give
10%
you
interest
$100.
rate, exactly, yeah. Is that clear or no?
So 10% interest rate will double your
So you
money?
get $100 a month.
Well, you gotta realize, it, this might look great, 10 years from now is a long ass time. You gotta realize that.
Yeah,
An
but what if it's
investment,
not $1,000? What if it's,
no, of course, but you gotta realize that when you invest in a 401k, when you, 401k, what's the average rate of a
6%.
6 to 8%,
Right.
right? And it's very safe.
Yeah.
Usually they invested in index that's across the market, usually shows an 8%. This you're lending to, hopefully it's Johnson & Johnson, but you might just be lending it to a normal corporation. You're gonna demand a premium to what you will earn on a safer investment. So say in this case, you're earning 10%. 10 years is a long time. You might think it's not. Real estate tends to go up, on average 6 to 7% as well a year. It's not that much, but yes, 10% you will earn per year. Up until the 10th year, you get back your $1,000, okay? So I want you to think about how you were valuing the bond. So remember we talked about present value when we were doing these calculations. You have your interest payments every year. The last payment you receive is the par value. And we're discounting that from a market rate, right? The $1,000 10 years from now is nowhere near worth $1,000. We can agree on that, right?
Because
Remember?
you're getting $100.
Exactly, yep. So what ends up happening is you discount each of these cash flows and you end up getting to a value, okay? We're not gonna talk about the value just yet, but I want you to understand you're discounting each of these cash flows by a market rate and you're getting to a bond value, okay? What would be the value of the bond if the coupon rate is the discount rate? What would be the value of the bond? You should be very intuitive because I just said it 2 minutes ago. Exactly. If the coupon rate is the same as the market rate, your bond's value is par. Because think about it. If you're earning exactly what the market rate is dictating, why would anyone give you more if they can just buy another security earning the same thing? They're gonna give you $1,000 because that's what they can earn with another security, it's the market rate. However, if your bond is special and it's paying 15% and the market rate is 10%, obviously you're not getting $100 a year,
You need more.
right? You're getting
15%.
$150. So
Right.
when you discount it, this value is not gonna be $1,000. It's gonna be an amount greater. You with me? So that's why it's said to be valued at a premium, because you are discounting a interest amount that is implicitly greater of a percentage than the market rate. Okay, so $150 discounted at 10% is worth more than $100 discounted at 10%. Okay, so you with me? So as you're discounting all the payments throughout the life of the bond, depending on the relationship between the coupon rate and the market rate will dictate what that value ends up being. And remember I told you it's a mathematical calculation. It's not like, oh, I think it's a premium. Oh, I think it's a discount. No, you actually do this evaluation method, just like we did with time value of money, and you calculate what the value of the bond. We're gonna do it on Excel right now. So look at the notes on the left. For a standard coupon bearing bond, the cash flows during the life of the bond consist of interest payments plus a payment equal to the par value at the end of the bond. So we know that. We get our interest payments every year up until the last payment, which is nothing more than the par value of the bond. Now I need you guys to understand, whether the bond is a discount or premium, at the end of the life of the bond, you're still just getting back the $1,000.
Right.
Because it's a contractual agreement between you and the issuer, okay? It's only a discount or premium if it's before that, because what makes it worth more than par or worth less than par is the fact that there's a difference between the coupon rate and the market rate. But once you reach the final stage, there is no difference between the coupon rate and discount rate because there's nothing to collect. So it's worth $1,000, okay? All right, so just some terminology here. VB is the value of the bond. RD is the required rate of return, which is the market rate. So it's the required rate of return. That's your RD, that's where you're discounting, right? We're gonna discount, so if it's a 15% coupon bond, right, it's obviously paying you $150 per year. You're gonna still discount those $150 per year by 10%. Okay, we're gonna discount by 10%. Okay, so
N is the years, right, out into the life of the bond. So you have your payment in year 1, your payment in year 2, and then obviously the $1,000 payment is in year 10. Okay, because it's a 10-year bond, the par value is collected at year 10. And then M is the maturity or the par value, right? So M is the $1,000. Okay, so again, the value of the bond, you're gonna have your interest payments. The interest payments you have to calculate because you know it's a par value bond at $1,000. The coupon rate, whatever it is on the agreement, you're gonna multiply by the par value. The stated coupon rate is always based off the par value. So it's a $1,000 coupon, right? I mean $1,000 bond. If it's a 10% coupon, you know you're collecting $100. If it were a 15% coupon, what is it?
Right.
No, if it's a 15% coupon, it would be $150. It's a 5% coupon, it will be $50, okay? So that would change here. If it were a 15%, let's change it.
Ooh, I got a good question.
Yeah.
I think it's a good one.
Let's just let me do this.
Yeah, I'll let you finish, I'll let you finish.
Alright, so let's say instead of 10% coupon, let's say it was 15%, right? So it's 15% coupon. This now changes to 150.
Saying 50.
Yeah.
This changes to 150, and what does this change to?
Stay the same.
Stays the same.
Excellent, that's a trick question. So it's still 1,000, right? Okay. You are gonna discount these interest payments of 150 per year by what rate?
10%.
Excellent. So you're gonna discount it by 10%. This is your discount rate, because it's the market rate.
Right.
So you're gonna discount your $1,000, you're gonna discount your 150 every year, and you're gonna come up with the bond value. Okay, what's that bond value gonna sell at? It's gonna be
It's gonna be less, right?
more premium, because it's
Well,
paying
okay.
more interest
That's
than
why I'm
that.
getting confused, cause $1,000. Now, the question I have, that's the premium, right? It's
Yep.
like insurance.
No, not
No.
insurance. The premium, it means that you locked in a rate
Rate,
that's higher than the market rate.
market rate, there you go.
So the bond is worth more than its par value
Now, question.
Yep.
Now, as you get the 150 per month,
per year.
per year.
I would love
per year,
150.
man, per year, yeah, I keep saying month, per year. Can a person notice if he's a scam artist, that he can recall your bond, if he know he's paying out more?
No, I mean, if the company, as I mentioned, if the company issued the bonds as callable bonds, they would be idiots not to call it back.
Back in 2 years, gotcha.
They will call it back as soon as it's exercisable. They can call it back because they're paying a rate higher than what the current
Gotcha.
market dictates. So that's what you need to realize, that you know you'll have certain provisions in contracts that make a bond more valuable or less valuable, and it all depends on what the rates are in the market, what the rate you locked in, how long to maturity it is. Because think about it, as I mentioned, what is worth more, this sequence, or if we're already in year 5? If we're in year 5, you don't have as many $150 payments every year. So the value is not gonna be as much of a premium as it is in year 1. You understand what I'm saying? So, all right, what was your question?
I was trying to find the terminology, and that was in the summary.
Yeah.
Where they pay you back increments of the principal
Right.
through with every interest payment.
Correct.
If they do that, does the
The life of the life of the bond shortens.
what does the with the fixed rate
The fixed rate stays the same. The rate,
not the fixed rates, but
The amount.
the fixed principal or the fixed interest rates that you would get, would those decrease because the principal is decreasing as
right,
well?
so the payments, what do you call it? The rate is the same, but the amount changes because it's based off a smaller principal.
Okay,
So it's like an advertising schedule.
okay.
Okay, sort of like when you're, think of it like with a mortgage company. Yeah, you're paying the same rate, right? But more is being applied towards principal than interest
Mhm.
with every monthly payment, because your principal is going down, so the interest is going down.
Yeah.
You understand? So it's a similar concept.
The par value is the present value?
No. Par value is the opposite of present value. It's the value that's agreed upon to be paid out at the end of the bond's life. And the par value is always going to be just the par value, whether the bond was a premium bond or a discount bond or a par bond. So par value is, what happened to? cross next to me. Sabrina, so par value is the stated amount, basically what was originally lent to the company. It's gonna get repaid at the end of the bond. So the par value, if it was $1,000 bond, you're gonna get back your $1,000 at the end of the life. When you talk about premiums and discounts, it's not in relation to the $1,000, it's in relation to the difference between the coupon rate and the market rate along the life of the bond. So when you're calculating the present value, you can have differences from the par value depending on the relation between coupon and market rate. Okay, so in this case, we said that if the coupon rate is higher, you'll have a higher present value, which is selling at a premium. Yeah.
Oh, no, I was looking at it, it's the sinking fund is what I was thinking.
Yeah.
And it literally says similar to amateur
Yeah,
emissions.
exactly. Yep.
Cool.
All right, so we're good on this? Any questions? Because I want to make sure that you understand, like, the concept is going to dictate, you know, pretty much your entire homework and the quiz itself. So I need you to understand that if a bond has a coupon rate the same as the market rate,
Par.
the value of the bond is going to be at par. If the coupon rate is greater than the market rate, it's going to be premium. And if the coupon rate is less than the market rate, it's going to be a discount. Okay? So let's show this on Excel. I want you to see this. All right, do you remember doing this a couple weeks ago on time value of money? If not, I'll clean it up a little bit. I was doing this during work. So, all right, remember this formula? Remember I mentioned it? It was the present value formula.
Okay.
So,
Yeah.
remember,
PV.
yeah, right. So we do PV, right? That's our present value. You come up with certain parameters, right? So we have our rate. What's our rate?
10.
10%. What's our number of periods? 10. What's our payment?
1,000? Or,
Payment is the sequence, like an annuity, the recurring
100.
payment. Right?
Okay.
100, very good. And what's the future value?
1,000 bucks?
Maybe
Very good. Why is that the future value?
Because it's
down the
par.
road.
Exactly. It's what you're going to collect in the future, right? So you put those all in. Wait a minute, I just.
So you're supposed to collect 1,000 in the future at the end of it.
Exactly. That's the par value. Yep. So you put this into the formula. So you see that, right? I calculate what the present value is of a security that has a rate of 10% per year, a number of periods of 10 years, a interest payment essentially of $100 per year,
10%, yeah.
and a future value, which is the par value of $1,000. You put those all in, you get to the value of the bond, which is nothing more than par, because your coupon rate is your interest rate, is your stated interest, the market rate. How could this change though? This can change if your payment, which is your interest rate, is not the market rate at 10%, but it's 15%. So in this case, it would be 150. So if I change it to 150, that amount should be greater.
Should be
Then
1,000 or something, right?
1,500.
Exactly. So now instead of being worth 1,000, it's worth 1,300. Does that make sense?
Yeah.
Now, to answer your other question, let's say that difference is no longer 10 years remaining. Say it's only 5 years remaining, right? Say it's a 5-year bond, not a 10-year bond. What do you expect the amount to get smaller?
Half? No, 3/4.
No. Here. No.
It'd be half, right?
I did something wrong here. Hold on.
So it'd be half the time.
Yeah. So it's 10%, 5 years. Oh, this is the number of.
Oh, you still got 150 in there, right?
Yeah. Right. That's the thing. All right, we'll go back to this problem, but you understand the par value and the discount. So this is the premium bond, and if this were instead of the coupon rate being higher than the market rate, and say it wasn't even $100, say it was $75, we know that it's not worth par, so it would issue at a what?
It's not worth par, so you have to issue
Par
a
means it's almost even.
Right, what's the term for that?
discount.
Discount, very good. So it's gonna be less than $1,000, which is the par. So it's gonna be $846. Is that clear? So instead of,
Alright, what's the
So-
change?
I'm showing you this. The only variable I'm changing is our coupon rate, right? For our coupon rate, we're not manipulating with the rate, we're manipulating with the dollar amount, because what our rate is in our problems, the rate, when we refer to the rate, that's always gonna be the market rate, that's the
Market rate.
discount rate. When we talk about the interest or the coupon rate that your bond is earning, that's gonna be your payment.
Payment. Oh,
Okay.
Okay.
So you calculate your payment, right? So you know if it's $1,000 par value bond and it's giving you 10%,
It's $100.
it's $100. You put in 100.
So if it's
If
15.
it's 15%, it'll be 150. If it's 5, it'll be 50.
Gotcha.
So if it's 5, as we said, that means it's a discount.
Oh, okay, gotcha.
Okay, so it's worth 692. If instead of 50, it's 150, it's worth 1,300. And if it's paying exactly what the discount rate is, it's par. Does that make sense?
So if the interest rate is 15%,
Yeah.
it comes down to $749, pretty much.
What do you mean by interest rate? The coupon rate or the market rate?
The market rate
If
is
the market rate is-
15%.
What's the coupon
then
rate?
The coupon would be 10.
Alright, so if this is 15%, yes, because you're basically paying less than what the market is demanding, so your will be less. It'll be $749.
Okay.
Okay, so again, you do a present value calculation and you fill in the
So
parameters
that'd
of,
be a discount or that'd be a
that's a
premium?
discount, because again, your coupon, which is 10%, is less than the market rate of 15%. So I want you to understand the parameters, so you have a present value, again, the present value is nothing more than the value of the bond, right? That is, the value of the bond now. So you fill in the parameters, the rate means the market rate or the discount rate, okay, it's what, not your coupon rate, it's the rate that the market is paying. Then you have your number of periods. Then you have your payment. Your payment is your coupon rate multiplied by the par value. It's the interest payment. You with me? And then your future value is your par value. Okay, so as you can see, you can play around the rates, on your own Excel, but as Jimmy just proved, if the market rate is higher than the coupon rate, it's a discount. If the market rate is less than the coupon rate, we say premium. And if the market rate is the same,
Par.
it's par, okay? So that is what the present value calculation is. You can see it's mathematical, it's not an opinion. You put in the terms and everyone is, if you're buying it in the open market, that's roughly what the bond should be worth based off the time value of money calculation. Okay? So let's continue. Any questions so far? Or we're good? Now let's talk about the composition of the value of that bond. So, you can do it in different ways, right? You can do the present value. Remember, in the bond agreement, you have two types of things going on. You have an annuity payment, right? An annuity is a fixed payment happening in every point in a moment in time. And the maturity value is the one-shot payment you get at the end of the agreement. So with the bond, you have interest payments that are being collected frequently. That's the present value of an annuity. Again, an annuity is fixed payments over a fixed interval of time. And then a present value of a maturity is the bond's par value at the end of the agreement. So you have the present value of annuity making of $614. You have the maturity value at $385. The total goes to equal the total of $1,000. Okay? So here, let's see if I can replicate that. So that's present value of an annuity. Let's see if I do present value. So here, the rate is, what is the rate? 10%. Number of periods is 10. Payment is 100. This should be right? So that's there's 614.46. You with me?
Yeah.
So on the Excel, I'm ignoring the par value at the end of the bond. I'm only focused on the interest payments. Okay? It's just showing you they come up with $1,000 in another way. So you can only focus on the interest payments and calculating the present value of those interest payments. So you put in your present value formula, you fill in the rate, right, the market rate, you fill in the number of payments, you fill in the payment, which is the interest payment, and you put 0 for future value, because we're not considering the par value at the end. We're only considering the present value of the interest payments, the annuity.
Present, so present value is 10%, right?
Present value, the rate is 10%, that's a market rate. You have your number of
10%.
periods, which is 10. You have your interest payment, which is the coupon rate multiplied by the par value, which is $100, and future value putting in 0. Okay, what's the other component that's missing from this? So we calculate the present value of the annuity. Now what do we want? What's the missing piece? The present value of,
Go back to the other.
Yeah.
And I'll tell you. It's the maturity value.
right, and what is the maturity? What is that? That's the par value we received, right?
Yeah.
So you wanna fill that in now. So you can do present value,
Oh, interest payments will be 0?
exactly, you got it, excellent. So 10% still the rate, right? That's still our market rate. Number of periods is still 10, right? Because we're collecting at the end of the 10th period. Our payment, like you said, is 0, and our future value is what?
1,000.
Very good. Fill that in, you get 385. What do you think the sum of the two is?
1,000.
Excellent.
So the 385 would be the maturity value.
That's the present value of the maturity value. That's the
I
present
put
value.
the PV in front of me.
Yeah, right. So the first component is the present value of the annuity payments, which are the interest payments along the life of the bond. The second component is the present value of the maturity.
Well,
at
I
the
got
end.
lost.
Is this on the list?
I got lost for the.
I'm not gonna remember this form.
The annuity part. So I do the same calculation.
But you nailed it, like, even to the formula, just get it like, you know.
Not
so-
gonna-
You can bring in an index card too, put in the formula.
Yeah.
You know what, not even an index card, you can bring in your full-fledged, no.
So the 10%.
Can you go back to the?
Yeah.
Second. Sorry about that. Thank you.
So the 10%. 10 years. Comma. So now I'm looking to do the annuity.
Right, the annuity is the interest payments, not the maturity value, only the interest payments.
So it's 10% then.
Right, 10%,
10 years,
right,
comma, and then it would be $100,
correct? And what's the future value?
1,000.
No,
Or
because you're only focused on the interest payments. So the reason this is important is,
it's not 100.
no, remember, this is only on the interest, so you're not focused on a future value, you're only focused on the interest payments.
Okay, so it'd be 0 then.
Correct, 0.
Close. Oh.
614, 46.
614.
And now you wanna do the same now, not the interest, you wanna focus on the par value,
Yeah.
maturity value.
Sure, so this is.
So you're gonna fill it out again, and the only thing you're gonna leave 0 are the
Is
payments.
the payment.
Excellent, and once you do that, let me know what you get, it should be 385 and 54 cents.
$385.54.
Right, and you add up the two,
Come out to 1,000.
1,000, which is the same as when we put everything into one formula. In the first formula, we included everything, we included the interest payments and the par value in the formula, and we got to 1,000. I was just showing you how you decompose it.
Okay, man.
Okay, so if someone asks you in the quiz, what is the present value of the interest payments, not the par value, you know how to derive it. If someone asks you, what is the present value of the maturity value, not the interest payments, you know how to derive that. So you have the decomposition of the full present value. Got it?
Okay, so maturity, you don't add
The interest.
The dollar amount.
Right, maturity, you only focus on 1,000, that's it.
Better not get this one wrong.
Okay, so we kind of did these already, but let's just, again, make sure we nail it. So what would happen if the expected inflation rose by 5%, causing the market rate to equal 15%?
Okay.
We said that if the market rate is higher than the coupon rate, the bond is selling at a
discount, right?
Yeah.
So that's why our present value, which is the value of the bond, is less than 1,000, right? If we did this, okay,
So we-
so we're saying that, here, 10.
PV,
So our PV here, you do PV,
15%, right?
we're using 15%, right? Then we're using number of periods still 10,
10,
payment is still 100, and the future value is still 1,000. We put that in, and because the market rate is higher than the coupon rate, we know that the present value is gonna be less than par, right? That's why we get
So that'd be the
749.
discount rate, then, right?
So it's 749.06, why did I get a different amount? Hold on.
I got the same thing.
Yeah, I think there's an issue on this. Some of these, I'm telling you, the publisher slides are so shit sometimes, like, it's terrible. Let me make sure this is.
Oh, that has 15 years instead of 10 years.
I have 15
Right.
years?
That's 15 year, I put 15%.
Yeah, this
That's what
is
it
15
is.
years.
It said 15 years. No, there's interest per year.
Oh, okay.
No, this formula should be wrong.
We say,
Let me
but that
just double
says,
check that.
they got it backwards, right?
Yeah, so wait, no, it's fine. The I per YR, it means.
Interest per year.
Interest per year. The N means the number of periods. So you have 10 years, interest rate of 15%,
Right.
and you have a payment still based off the coupon rate, which is 10%, so 100, and the fair value, future value is 1,000. This is absolutely wrong. Let me just go with it.
What's the PMT you said?
That's the coupon rate times the par value. It's the interest payment you're collecting along the life of the bond. So 15%, 10 years, $100 payment, future value is 1,000. Should be 749.
That's what I have.
Yeah, it's wrong. Maybe I corrected it later on. Let me see if I corrected something. Thought I did. Let's see if they do it wrong here. What happens if the market rate declines to 5%?
Go up.
It will go up above the par value, so it should be 1386. Yeah, these are, I don't know what the hell is happening here. Let me check my old notes. See, this publisher always screws me up. I probably corrected it in the previous class too. So this is control, and this is. What slide is this? This is slide 12.
I think this class said 12, right?
Yeah, this should be
Mine,
slide
I
12.
came out with 1386.
Yeah, it should be lower ones. This is so annoying, because now it's asking me questions. I gotta go look it up. Bless you.
Bless you.
Thank you.
If market rate is greater than the coupon rate, that means your bond is worth less than the par, so it'll be issued at a discount amount that's less than par. If the market rate is less than the coupon rate, that means your bond is worth more, so the value of the bond is greater than the $1,000, okay? So it'll be more than the 1,000.
So 1386 is
Right,
more.
it's 1386, correct, not 1210. Alright, so we nailed that, we know it. So let's go to the next, actually, you know what? Let's take a 10-minute break, and then we'll come back, because there's still lots of